Okay, welcome to chapter 37. In this chapter, we're going to be talking about all the different forms of partnerships. Like a lot of things in the law, these started off with some relatively simple forms, some simple structures, and then as lawyers got their hands on them, they matured into more complex entities and into more complex iterations of themselves, and the result of all this is that there's lots of things to talk about with partnerships. Having said this, these are very old ideas and entities. Partnerships have existed for hundreds of years under the civil and to some extent, criminal law. So let's go ahead and jump in and start looking at some of these. The first thing to understand, basic concepts about partnership, is that a partnership arises typically, and when we use these terms, express or implied, I want you to think about these terms, although not exclusively. When I say express, meaning written, and implied, meaning by action. So partnerships arise either from a written agreement or agreements that arise because of the way people behaved. It has to be between multiple partners, parties. There's no such thing as a single partnership. One person can't be in partnership with himself, and if he has no partners, it can't be a partnership anymore. So it's an agreement between two parties to carry out a business for profit. And the most common are what we call ordinary partnerships or general partnerships. And a little bit later, as I said, when lawyers got their hands on things, we created limited partnerships and limited liability partnerships. And those have some different structures and a little bit different impacts. Okay, so there's several parts of the law that influence partnership. Obviously, the contractual part of this is the partnership agreement between the two, but you've also got agency, and we've talked about agency before. I think it was at the end of Business Law 1, where we talked about the idea of master to servant, using the old terms, or agent to principal, or employer to employee. So there are some agency concepts that float around in partnership law. Each partner, in many ways, operates with the other partner as being his agent. So if you have A, B partnership, B is both a principal and he's the agent for A. A is both a principal and he's the agent for B. Now there's a few differences there in that an agency doesn't necessarily have co-ownership, and there's not necessarily any sharing of profits and losses in agency. So that really distinguishes agency from partnership. Now, like many areas of the law, and I guess I'm repeating myself for that phrase quite a bit, but like many modern areas of the law, the different legal entities, the American Bar Association, the different state bars, all got together and tried to create a uniform body of law in this field. And what they created here is the Uniform Partnership Act, or what's called the UPA. And the important about the UPA is it's more a default. If your contract, if your partnership agreement, which is abbreviated in these notes as PS, if your partnership agreement, PS is partnership, but if your partnership agreement is silent, or there is no agreement, then we're going to turn to the UPA. But your partnership agreement can modify all these rules. So one of the things that lawyers are brought in to look at is, of course, drafting partnership agreements or explaining what the rules are. Now, all states have adopted the Uniform Partnership, the UPS, and the UPA as well. They've all been adopted. I think, Uniform Partnership Act is pretty important. We're going to look at kind of the presumptive definitions there. Okay, having said that, I think that, let me just change that there. Okay, let's move on to the UPA, defining partnership. So what is a partnership? An association of two or more, as I said, you can't have a single partnership, persons can be very broadly interpreted, to carry on as co-owners of a business for profit. Now, you have to intend to have created a partnership. So generally, you can't have a partnership with involuntary partners. It's a voluntary state. And sometimes there's a fight about whether a partnership truly exists or not. One party says, well, I didn't mean to create a partnership with you. Well, then what factors do we look at? The big one is, did you agree to share profits and losses? Then we also look at things like, well, is there joint ownership of this business? Is there joint management rights to this business or equal management rights? When something isn't a partnership, well, merely making an installment paying or debt payments, that's not a partnership. Wages to employees, that's not a partnership. Rent to a landlord, not a partnership. Annuity to a widow of a deceased partner, and this can occur if you've got a law firm with 20 or 30 people in it, and one of the partners dies. He had a partnership interest, and very frequently what will happen is that widow or widower, if it was a female partner, would continue to receive money from the partnership, as often an annuity, although more frequently, in at least for lawyers, in a lump sum payment funded by an insurance policy. Okay, so the other thing about this is there's kind of a split in the law. Is how do we look at a partnership? Is it a separate legal entity, like a corporation is a person? Or is it just the aggregate of two people? So partnerships can be seen as both of these. It's not a contradiction to say it's both an entity and an aggregate. But what happens is in some areas of law we treat them like entities, and other areas of law we treat it like an aggregate. So partnerships can be just seen as separate entities. Partnerships can be seen as the combining of the two parties. At common law, partnerships were not entities. They didn't have a separate legal existence. So you couldn't famously say partnerships are people. You had to sue the individual partners separately, not the entire partnership. Now, the entity theory, a little bit different. The entity theory asks, do you have legal capacity to sue and be sued? In most states, yes. Judgments. If a partnership loses a lawsuit and has a judgment, then the partnership pays first, not the partner. So that would tend to tell you that, yeah, partnerships are entities. We can marshal assets, where we establish priority, and if you're ranking creditors' debts, first you go against the partnership, then against individual partners. Bankruptcy. Federal bankruptcy law recognizes that partnerships can declare bankruptcy, and it doesn't necessarily affect the individual partners, although it usually does in some way. Individual partners can declare bankruptcy, and this does not necessarily impact the partnership itself. Can partnerships own property, and can they buy and sell it? Now, in North Carolina, only the partners. So if you go, there's not in the little line, who's the owner here. In North Carolina, there's not a little box that you can check that says partnership. You've got to have corporations can own property or people, but not partnerships. Now, the aggregate theory, if a partnership is not a separate entity, then it's an extension of the partners. Now, where is this most important? Taxes. Because typically a partnership is a tax reporting entity. It tells what income came in, but it's not a tax paying entity. There's not a separate form for the partnership to pay taxes. So what it files every year is what's called by the IRS and North Carolina Department of Revenue, or the South Carolina Department of Revenue, whatever it's called down there, an informational return. How much money went into the partnership and went out to the partners. And then the IRS knows, okay, well, ABC partnership, C got $50,000 from the partnership because we have this information return. That better show up on his individual 1040 form. Okay, so partnerships can be oral or written or implied. 99 times out of 100, they're going to be a written. Sometimes they'll be oral, maybe 1%. Very rarely will it be an implied partnership. Now, sometimes the statute of frauds, depending on what the partnership's doing, this triggers, if you recall, the equal dignity rule, requires that it be in writing. Almost always, you're going to have a partnership and you're going to have a document. And this document is almost always called the Articles of Partnership, and it sets it up. It's important because in many states, including North Carolina, you're going to file these Articles of Partnership. and the state of North Carolina is going to recognize you. So the duration of the partnership can be set forth in the articles. This used to be more of an issue. Limited partnerships, maybe they do accomplish a goal, like, okay, we're forming this partnership to dig a gold mine. We're forming this partnership to get to the moon. Well, once you get to the moon, the partnership should end. Most of the time, partnerships have unlimited length. That unlimited length means that you can dissolve the partnership when you want. You don't have to wait for it to be complete. Now, obviously, to be a partner, to enter into a partner, you have to have capacity. It's one of the underlying forms of contract. This is a contract, so you have to have capacity. If you go insane or you become incompetent, it doesn't automatically end a partnership, but if you have a court order that says yes, you're now insane or incompetent, you're the only other partner, and we're down to one partner, that very well could end it. Corporations. Now, can corporations be partners? Yes. The UPA says corporations can be partners. And now some states restrict this a little bit more, not too much in North Carolina. But essentially, we allow, since corporations are treated as people in many ways, at least civilly, we allow them, like other people, to engage in partnerships. Now, partnership by estoppel, really a favorite topic of your book, but pretty rare. This is when a court says, you guys acted like a partnership, so implied. So we're going to impose, we're going to claim that you are partners, and we're not going to let you deny that you are partners. We're going to stop or stop you from claiming it. Now, it doesn't actually create a perfect partnership, but it does impose liability. We also see this with agency by estoppel. Again, something that can happen, but really is pretty rare. All right, so you've got partners. Who gets to make the decisions in the firm? So let's suppose we have a partnership, and we'll make this a partnership, do something relatively simple, landscaping. Okay, so you've got Abel, Baker, and Charlie Landscaping, ABC. The general rule is that A, B, and C all have an equal right in management. Now, let's suppose A had donated all of the money to form this partnership. Let's suppose the partnership cost $100,000 to form by equipment. He had donated all the money, and he was working full-time for the partnership, and the other two just gave $10,000 each. Okay? No, they were just named as partners. They didn't contribute anything capitally. It wouldn't matter. If the partnership agreement is silent, then it doesn't matter. The three of them each have an equal voice. Now, you could change this in your partnership agreement. You do, no matter what, need unanimous agreement for some partnership issues, like you're going to change the essential nature of the partnership. You're going to change from a landscaping company to cleaning nuclear reactors. If you're going to admit a new partner, you got to have a unanimous agreement. If you're going to assign partnership property, like trucks and stuff that ABC Landscaping owns, to creditors in trust, you got to have a unanimous. If you're going to sell the goodwill of the partnership, now that means almost always you're selling the partnership name. If you're going to make a confession and judgment where you're going to say, yes, the partnership has liability, they all got to agree. If you're going to do something that would make the partnership impossible to continue, or if you're going to amend the articles of partnership, all of those better be unanimous. All right, now, you do get a percentage interest in the partnership according to your partnership agreement. However, if there's no agreement, you get an equal share. So A contributes $100,000, B contributes nothing, C contributes nothing. The business makes $100,000. Who gets the money? You might say, well, A should get it all. He gave it all the money. No. If the partnership agreement is silent, they each get $33,000 and a third. Now you can change that. You can say the person who contributes the capital gets his capital return, or you can change it that they get 90% or whatever you want. But if the partnership agreement is silent, everybody gets an equal share. The other thing is, generally, if you're working in a partnership, you don't get paid. You don't get special compensation. Now, you can be hired, and the articles of partnership can say we're going to hire people or we're going to pay, but the general rule is partners don't get paid. They get their money by sharing profit. If you're a partner, you have a right to look at the books, and those books, accountancy books, how much partnership's making or losing, have to be kept at the place of business. There has to be an accounting to determine percentage profit and ownership. And this can be really important. I mean, if you get a very large and complex partnership, a serious question can arise as to, is it making money? Is it losing money? Who gets what? So you may want to be able to determine this. Now, this can be a voluntary accounting. You can say, okay, I want an analysis of the books to find out what I'm owed. Or it can be mandatory. A court can say, we think some chicanery is going on, that you've been defrauding a partner. We're going to order it. You can demand a formal accounting if it's called from the partnership agreement, which usually is, if there's an option for it. If you've been wrongfully excluded, which usually means you got to go to a court to get it. If there were withholdings in breach of duty, or if it is, quote, just and reasonable, and that's language from the UPA, the Uniform Partnership Act. So a partnership, let's go back to ABC Landscaping. There's three basic property rights in here that are balled up. One is an interest in the partnership. A, B, and C, let's just suppose they all contributed equal money. They each have an interest in ABC Partnership. Now they also, let's suppose ABC Partnership bought 10 trucks for $10,000 each. They also have interest in specific partnership property. So they have the interest in the property that's owned by the partnership. So the value of the partnership and then the property owned by it, which are obviously related. And then they also have a property right to participate in management, which is an elegant expression of the idea that you own the right to manage. Your interest in the firm is basically proportional to whatever rights you have to profits and assets. So again, if it's silent, you're going to get an equal amount. If it's not silent, we're going to look at the partnership agreement. Now, sometimes a partner owes money, and a creditor comes and says, "Hey, A, B, and C. C owes me $10,000. I want that money." You're not going to let that creditor come in and start making orders to the partnership. But what he can do is he can get a charging order that says, you're allowed to get C's profits that come out of the firm to the $10,000, but you're not a partner. You don't get the management rights, and you don't get specific rights of interest. All right, if you buy it or donate it to the partnership, it becomes partnership property. And the more closely the asset is linked to the partnership, the weaker any other claim of ownership is. And you can have instances where, well, I took the truck home every weekend, or I used it every other Wednesday to drive my mom to the produce market. That's pretty weak. Partners can buy, sell, or take loans against partnership assets for their own benefits. So you got to be careful here, because they have an interest in it. Now they're going to have to disclose, and anybody that would take part of a partner's interest in a piece of property that's owned by a partnership and just his is a bit of a fool, but it can be done. Fiduciary duties. Each partner, as I said, is the agent of the other. We've talked about agency and partnership, and they operate as agents for each other, and they are principals for each other. You have a duty of loyalty and trust to these other partners, and this underlies the whole thing. You can't behave like a jerk and expect the law to save you. Each partner, as I said, is an agent for the others. Individual partners can create liability for the partnership. Now, not if they're acting outside the partnership. So ABC Landscaping, and C goes home, gets drunk, and runs over the neighbor's dog, not driving an ABC partnership. I didn't create any liability for the partnership. Okay? Individuals can create liability for the partnership. Now, let's suppose a third party knows that C has no authority to enter into contract under the agency, but goes ahead and gets him to sign as a partner. He hasn't created liability for the partnership. Generally, though, we assume that all partners have the ability to enter into contract, and particularly what's ever customary there. And if you act within the scope of authority or assumed authority, then you combine that partnership and all the other partners to it. So, in many ways, I like to tell people about partnerships, it's a lot like a marriage. You have a lot of the same issues there. Okay. Joint liability, several liability. Joint liability. A partner being sued because he's a partner can bring the other partners in to defend him. So let's suppose that A does a bad job landscaping. He gets sued. They don't name the other partners by Acme Business. Well, he can bring B and C in to help him because there's joint liability there. Now, when we talk about joint and several liability, if a tort or breach of trust happens, you can sue one partner, you can sue them all. But remember, if you're going to sue one, he generally has the right to bring in the others. You can pick and choose who you go after. But if you're going to execute, you can only execute against him, sometimes against the property owned by the partnership. What about new partners to come in? So we have A, B, C landscaping, and they decide to bring in D. Well, when a new partner contributes, let's suppose in order to buy into the partnership, you had to give $10,000. Well, if he buys in on January 1st, 2021, that $10,000 can be applied to all debt, all liabilities that existed prior to that. After he joins, he is liable because he picks up that liability for all debt after that. But he doesn't have liability personally until after he joins. That makes sense. All right, let's suppose partners want to leave. We've got ABC partnership, and C decides, I want to leave. Well, that's called Disassociation of Departure. Now, it could be because an event triggers it. ABC, C suffers a stroke and is unable to work. Let's suppose everybody agrees they're going to get rid of a partner. Or let's suppose there's a court order. Court says, kick this partner out. Or a bankruptcy. Right? It also could be triggered legally. If you've got a law partnership with ABC and C loses his law license, there's going to be a dissociation. Now, sometimes people wrongfully disassociate. They kick someone out when they shouldn't kick someone out. Now, what this can happen is that can create liability for the partnership. Of course, the reverse can happen. Sometimes they can say, I'm leaving. I know I don't have a right to leave, but I'm leaving. That can create liability to the other partners. So A, B, and C was doing the work, and A and B had invested a lot of money, and C decides, this partnership's not working out, I'm out of here. Well, that's liability that C's creating if he's wrongfully leaving. Now, that's why you always want to look at a partnership agreement and have the mechanisms of dissolving the partnership in it. To say, okay, when can someone leave? What do they have to do? What kind of notice do they have to give? So what's the effect of disassociation? It terminates some of the rights of the leaving partner. And it creates mandatory duties for the other partner. So you lose the right to participate. Your loyalty to the other partners ends, although you're still going to have a duty of care of any partnership. Very often you're going to buy partners out. And this can happen to people who are successors in interest. Remember, I kind of talked about this, and we're going to touch on it a little later. You have a partnership, ABC. Let's make it a legal partnership. So it's ABC law firm. And we decide, okay, we're going to, C dies, and his wife inherits the interest in the legal partnership. Well, we're going to buy her out. I mean, she's not a lawyer, or he's not a lawyer if the female partner died. So we're going to buy him out at whatever is the price, and we'll set a valuation date of the date of the dissociation, the death of the party. Now, for up to 2 years, a partnership may be bound to an existing partner's acts under the doctrine of apparent authority. So what does that mean? That's why when a partner leaves a dentist firm or a doctor's firm, you often will get a little note in the mail that's saying, Dr. Smith is leaving ABC Dentistry. Why? Because once you know, there's no more apparent authority and he can't bind the partnership. Okay, partnership termination. You can end a partnership for lots of reasons, generally for any reason. Again, I know I say this a lot, and you're probably sick of hearing it, but you can end any contract you want if you're willing to pay the cost of ending it. And the 2 stages of ending a partnership are the dissolution, I'm going to end it, and then the winding up, let's shut this down. So dissolution by agreement. This can happen. I've seen law firms break up where partners say this isn't working, or I'm not going to be a lawyer anymore, I'm moving, or we don't get along. We'll just agree for it. And this can be in the partnership agreement, or the partners can all agree later. You can't compel someone to stay in a partnership or to join, but when you have the right to leave and the power to leave are two different things. So in other words, if you leave and that causes damage, yes, you have the right to leave, but you're going to have to pay. If they admit another partner without consent, you're giving the other partners the right to withdraw. Remember, that's got to be unanimous. If you transfer a partner's interest, now it doesn't necessarily end a partnership, but most of the time it does, or it can. You can have dissolution by operation of law. So if a partner dies, obviously he's not a partner anymore. If the partner goes bankrupt, or the partnership goes bankrupt, or if whatever the partnership is doing becomes illegal, that would be automatic. You can have a judicial decree, which is close to operation of law, but it's a judge that says, okay, this partner is insane now, or is non-competent, is incapacity, or he suffered a stroke and can't do his job, or her job. Business impracticality. It's impossible for this to make a profit anymore. Improper conduct of a party, or other circumstances. So you can go in front of a judge sometimes, and the judge can say, you know, this is just a mess. And we don't want to have this partnership around anymore. We're going to dissolve it. Withdrawing partners communicate their withdrawal to the partners and all affected third parties. Let people know you're pulling out. Let people know that you're not in the partnership anymore. If you're actually dissolving the whole partnership, not just one person pulling out of the partnership, then you've got to wind up. No new business. And then it's kind of like that bankruptcy we talked about earlier, kind of like an estate. You're going to collect the assets, you're going to distribute them out, you're going to pay off. So what do you pay out? Well, first of all, is there anybody outside the partnership? We have ABC partnership. And let's suppose ABC borrowed $10,000 from Wachovia. Great, that's a third party. You pay them off first. But let's suppose B had lent ABC partnership $10,000. His partnership maybe was in some trouble or something. Well, we'll pay off Wachovia first. Now we'll pay off B. Now, let's suppose that A, B, and C had, there's $10,000 to Wells Fargo. There's a $10,000 loan by B. And each of A, B, and C at the beginning of the partnership had contributed $10,000. That was their capital contribution. Okay, so Wachovia gets paid, B gets paid the loan, and then we're going to pay the capital contributions. If there's money left over, we go to the partnership agreement, see how profits and losses were divided, and then we take the distribution of the rest according to that. If assets are insufficient, then the partners pay off the outside debt. If one partner winds up paying more, he can get a refund from the other partners and he can get money from them. It's called the right of contribution. Buy-sell agreements. You can set up provisions of partnerships to buy partners out. And that's pretty common. Usually you're buying out conditions. You're buying out their interest in the partnership. As I said, and this happens in law firms. You have a female partner who dies, and her husband is, say, a doctor or is a plumber. Well, he's not equipped to be a lawyer. So he's got an interest in the partnership. You want to be able to buy him out, the widower. So this is very common that you see buy-sell agreements set up. All right, now we start to see the new types of partnerships. Limited liability, limited partnerships. Now, a limited partnership's a little different. But as in 1991 in Texas, which technically LLLPs, limited liability and limited partnerships, don't exist, but North Carolina does have limited partnerships, and it does have limited liability partnerships. It just doesn't have limited liability limited partnerships. And that sounds confusing, and it's going to be clear when we look at the charts at the end. Okay, so let's talk about limited partnerships to start this. In a limited partnership, you got two types of partners: general partners and limited partners. The general partner runs the thing day to day. He's just like a regular partner, a regular partnership. He's got unlimited liability. A limited partner has invested money in the partnership but has no right to run it. And their liability is limited to their investment. Now, he can't run the partnership. If that limited partner, let's suppose you have a general partner, we'll call her Joan. Okay, so Joan is the general partner and Peter is a limited partner, because you could have just two people in this. The limited partner Peter makes a $10,000 investment. Great, his liability is $10,000. Her liability is whatever, however much it does. But if Peter decides, well, I want to help running the place, then if you give him management duties, okay, he loses his limited liability status and he becomes treated like a general partner if debts arise. So you got to be careful there, because people sometimes, you have this kind of creeping idea of, I want more authority. My money's at stake, so I want to start making decisions. Once you start doing that, you're going to start creating liability. All right, if we have the Partnership Act, remember we have the Uniform Partnership Act, we have the Uniform Limited Partnership Act. Now, this is adopted by most states, I believe, including North Carolina. There's a revised one circulating now. And one of the things that has to happen with limited partnerships is you got to let everyone know they exist. Because after all, if you've got someone that's a limited partner, it's not like you can sue him for everything he did. You can only sue him for his capital investment. So it's treated a lot like a corporation. And when you file your limited partnership with the North Carolina Secretary of State, you're going to get a certificate of limited partnership, and the whole world's going to know. They're going to know who the general partners are and who the limited partners are. So limited partners in a limited partnership are treated a lot like stock owners. General partners, they're treated just like regular partners under regular partnerships. General partners have the power to withdraw. Limited partners have to give a 6-month notice, usually because there's money that goes out. Outside creditors, if there's money owed, have priority. Then we pay the limited partners. Then you pay the general partners. So limited partners, you've got a little bit more right to get to the money than the general partner does. Again, this is one of those areas, I think, where if you're thinking about investing in a limited partnership, you need to have a lawyer look at the partnership agreement, and you need to have an accountant look at it to see where get a financial statement. North Carolina has, this is a correction. We have limited partnerships, we have registered limited liability partnerships, and now we have limited liability limited partnerships, although I've never created one. So what do they look like? Here's the comparison. General partnerships, created by agreement, default status if no other thing is chosen, everybody's a general partner for each other. It can be managed by oral or written. Partners have unlimited personal liability. It's a tax reporting, not a tax paying entity. Terminates when a partner dies or withdraws. Limited partnership. You create by filing a certificate of limitation, limited partnership. You have general limited partners. General partners have unlimited liability. Limited partners have liability to their capital contribution. Everybody's taxed individually. Terminate on death or withdrawal, at least of general partner. Limited liability partnership, created by agreement and filing registration. Manage oral or written agreement. Each partner has unlimited liability for general obligations, but only to capital contributions from malpractice. This is where you usually see it for law firms. You'll see an LLC, limited liability partnership, LLP. Limited liability limited partnership, creates by agreement. General limited partners. Each partners have unlimited liability for general, but only capital contribution. Limited partners liable only to capital contribution. Termination on death, withdrawal. Again, that last one I've never really messed with much, to be honest. Okay, that's right around 35 minutes. When you come back, we'll pick up. And again, there is an error in my initial lecture here. I said North Carolina does not have limited liability limited partnerships. We do now. So I'll go back and fix that in my notes.